now recording the session. All right, no questions? Okay. Excellent. All right, well, let's start with the tasks of the week. Most of you have done these, but just a reminder, we want to create an email for our real estate, separate the emails from our personal to our business. Real simple. It doesn't take much time. A Gmail account is fine. It's important because we're going to use this email in our business card when we create that. And I talked about, trying to keep it simple for the business card. Your name, I believe, is your brand. And having your name and email address underneath with maybe, Property Solutions as a name underneath is quite enough. You need to control the conversations and the communications with people. So I always like to start with email first. Create a separate telephone number. You can go to freephonline.ca as an example. Skype, also Comwave has a service. Just creating a separate telephone number, same concept, same idea, just separating our business from our personal. Create a business card. You can go to Vistaprint. You can also go to Staples, has a program. I think it's $500 or $250 for $10. Very inexpensive. Next day you can get it. So if it's something that easier just to get them from there, or you can order them from Vistaprint, has a great program too. Just again, keeping it simple. When you're in contact with someone, it's real simple. Flip the card over. If you want to put the number on or on the front of the card, you can put the number that you've created if you feel that it's appropriate for that kind of communication at that time. And you can also identify what the relationship was, investor, buyer, seller, etc. And create a business space in your home. This is important, good for taxes, important for taxes. We want to make it, simple. Keep all your receipts. What I say about this area is not to do anything except business. I would not Skype or, unless it's business related, but I wouldn't stream or even social media. Try to keep that space kind of sacred in your home and allow yourself to be mentally prepared when you walk in that space to do business. The last thing that I don't have on here, I think is important, is to download a log for your mileage log. There's many out there. An example would be Mileage IQ, and what it can do is it recognizes when you're moving faster than a walk or a run. It assumes you're in a car and starts to track where you are and where you're going. And at the end of the trip, it asks you how to identify it. Okay? So those are the tasks of the week, the main ones that I want you to work on this week. In addition to that, my folks from Edmonton and everyone, I think we should be, as a goal, evaluating 5 properties a week. Initially, it can be fake properties, like you just make them up. What I really want you to do is understand the numbers and see how those numbers affect each other. Today, we're going to go through the 6 key indicators. I think it's easier to look at this point and to understand those key metrics. And then what we can do is work towards the larger, more in-depth sheet, cash flow sheet, and look at how the additional information will help us. But the 6 key indicators is important because it allows us to understand if there's anything worth looking at, looking further at this particular property. Okay, so let's do this. Do I have any questions so far? Are we good? Excuse me. You can hear me okay, everybody? It's clear? Okay, good. All right. Okay, good. All right, so let's do this. Before I go off this screen, if you haven't already gotten these files, you can download these files. So copy of the cash flow sheet. Most everybody's got that. Building a power team. 6 key indicators in terms of conditions of Schedule A. These are the conditions that we would want to put in the contract. So if you haven't downloaded all 4 of these files, please do that now. I'll give you a few minutes just to click on them. You can click on them and download them right from here, and just open them up to make sure that they open up fine for you. Okay. So I'm gonna go on pause for a second, just give everybody a chance who doesn't have them yet, especially our new group from Edmonton, to download those files. Go ahead and do that now, please. And somebody, if you could just test them by opening them and let me know in the text box that they opened up fine. somebody who's downloaded them could just let me know that they open up fine, that would be appreciated. Unable to download, Aaron. What's happening when you download? Kevin, the Excel sheets are not opening? What happens when you open them? So when you do open up those Excel sheets, just want to let you know that you have to, opens great, good. You want to make sure that you enable editing, and you can disable macros. If you get a macro message, you can disable the macros. But all those files should be okay. Is anybody doing this from their cell phone? Because if you are, you might have some challenges. Aaron, are you doing that on a cell phone? Where are you doing that from, Kev? Tablet? Okay, the tablet may not be able to do that because maybe you don't have Windows on it. Good. You're doing it from a laptop. Download done. Good. Kevin and Heidi from a laptop. Do you have a Office on that, Kev? You do. Well, that's weird. Yeah, Aaron, that might be the way to go. Okay, so this is what I'll do. Give me 1 second. So, Kev, anybody, Aaron, did you get them? Or you have to? If you want, Aaron, I can, or anybody who can't get them open, I can send the files to you. Kev, you want me to do that? Okay, so Kev, can you send me an email right now that says, Sam, can you please send me the files? And I'm making a note to send them to you. If it's a Mac, it won't work either. If you have Windows, I use it on Mac. Fiona, if you got Windows on it, should be no problem. Windows Office running Office on it. So Kev, I'll send them to you. Fiona, you want me to send them to you too? Okay, so Fiona, send me an email right now. I'll send it to you too. And okay, so that's Kev, Fiona. Aaron, you good? Or you want me to send them to you too? Aaron, you good? Okay, can you send them to, yeah, Julian, I'm sending them to Fiona. I can send them, oh, you can send them to Fiona, good. Cody sent them, send them to me as well. Okay, Cody, so just make sure you write the email and I'll do it. Aaron, I'll do it for you too, my friend. Just make sure that you guys send me the email, okay? So I can send it back. Okay, so I have Kev, Fiona, Cody, and Aaron, but Fiona, I think you're going to be okay because Julian's doing it, so that's good. Okay, good. So just Cody, Aaron, and Kevin, right? Everybody else is good? Kevin, hi, yeah. I mailed you too. Kev, okay. So Kev from Edmonton. Kevin, Edmonton. Okay. Okay. There we go. Good. All right. Okay, so we're good. Let's open up, let's look at the 6 key indicators. Can everybody open up the 6 key indicators, please? We're going to go through that now. So I'm going to share my screen and we're going to go through the 6 key indicators. Let me just open that up. Okay, can everybody see that? Okay, good. The black box that you see at the top there, that's a box that I have to keep open so I can see you and keep the text box open. So we'll go through this together. The main reason going through this is to explain the 6 key indicators, 5, 6 key indicators. Not all of them are as important as the next, but I will explain the relationship for them. So in this 6 key indicators, all we really need is asking price, purchase price. Asking price really is less important, but it's good for you to know. So asking price, purchase price, number of units, gross revenue, it automatically adjusts and assumes that we're going to be around a 35% expense. Might be a little bit higher, but just initially, it's important for us to have some numbers to work with. So purchase price, number of units, and gross income, which is relatively easy to get. And what this does is it gives us, an estimated net operating income. That's NOI. That's what that stands for. Okay. So then, if we go over here, we see financing. We assume the 75% financing, $75,000 because it's a $100,000 property. Seller financing, we're always going to ask for that VTB, 15%. That's going to be $15,000 in this $100,000 property. And out of pocket, 10%, as we know that we like to only put 10% or less in a property. Okay, that's going to give us $10,000. The total is going to be obviously $100,000, 100% of the financing covered. Now, what this is, we call it James Bond, but it's a really quick way to calculate estimated cost of carrying those loans. It's telling us $8,400 is what it's going to cost to carry those loans. So the cash flow is taking this number here, the $13,000 minus the $8,400, which is the carrying cost. It's telling us the cash flow will be $4,600. Okay, does that make sense? Anybody have any questions so far? Okay. Okay. So cost per unit, it says 50,000 or less. I don't want you to worry about this one. Don't worry about this one. Okay. GRM, great metric, excellent metric to better understand, if there's an opportunity early in a deal. So let's focus on GRM for a second. Now it says 6 or less. It says 5. The GRM is 5. Now GRM stands for gross rent multiplier. Okay. Gross rent multiplier. Okay, so it's important for us to know this metric initially, because typically we don't get a ton of information from the sellers often. So this helps us evaluate relatively quickly, if a property has an opportunity or not. Okay, so let's look at that for a second, GRM, and better explain how GRM works. Okay, 1 second. Okay, so GRM is gross rent multiplier. Okay, so what does that mean? Well, gross rent multiplier is calculated simply this. You take the gross rent divided by the cost. Oh, let's do it the other way. Sorry about that. So purchase price, I did that backwards. Purchase price divided by gross rent. Okay, everybody understand that, right? Purchase price, gross rent. So right now we have a purchase price of $100,000, and we have a gross rent of, $20,000. Okay, so as the formula states, what do? We take equals this divided by this. Okay, and that gives us the 5. Does everybody understand that? Is everybody good? Pretty simple metric. Yep. So we like this to be 6 or less. We don't want this number to be bigger than 6. Why? Well, let's say that the gross rent was $10,000. If the gross rent is $10,000, then the gross rent multiplier would be 10. That means I need 10 years of gross rent to cover the cost of the property. Okay. Now, why is that not good? Well, obviously, the higher the number, the less gross rent we're bringing in, right? And the gross rent is what we start with before we start looking at expenses. So we want the highest possible amount coming in. Now, obviously, the market determines that. We can't change that. But what we want to understand is, the reason that we use the number 6 is because if we can get a 6 GRM or less, what that's going to do is it's going to give us a good cap rate, which I'll explain. It'll also should give us a good cash flow and a good cash on cash return. Okay, so if you have higher than 6, typically these other numbers are not going to, they're not going to come up. They're not going to do well. To give you an example, just to go like this, let's make this 200,000. So 200,000. All right, 200. That's 2 million. Let's go back. Okay, so what you see is this. The gross rent multiplier is 10. The cap rate is 6.5, and we're looking for 10 or higher. So that's no good. Cash flow is negative $79.17. Cash on cash return is 19. Right, and this is where it's great to play around with these numbers to see how they affect each other. As a rule, GRM, you want that 6 or less. That should bring these numbers close to or in line to a potential deal. So when you see a gross rent multiplier of 10, there's not much opportunity here for us to do something with this property. And what's great is gross rent multiplier only looks at purchase price and gross rent. Okay, purchase price and gross rent. So that's pretty easy to get from a seller, right? Not hard to do at all. Okay, so what I want you to consider is when you're looking at these properties, if you quickly getting that information, if the gross rent multiplier is, if it's 8, we can work with it, we can get it down, but if you're in 10, 12, it's tougher. I'd like you to stick around the 6 mark because that's going to give the rest of the numbers an opportunity to also work. Okay, does that make sense to everybody? The only option with a gross rent multiplier of 10, anybody know what we can do with a gross rent multiplier of 10? What we still possibly could do? Anybody? Anybody got an idea of what possibly we could still do even if the gross rent multiplier was 10, which is too high? No? Okay. All right. Let me tell you then. Let me tell you, that's okay. Yeah, exactly, Todd. You got it. Yep, Charmaine, yep. You just assign it. So let's say that this was to 275. Good job. 275, we could still wholesale it, because if it's 275 as a retail, 200 we could assign the property, even though the gross multiplier is 10. Obviously, this is this is what they want, asking price. This is the purchase price. We're going to assume most asking prices are close to retail. Obviously, we would vet that and verify that. But at the end of the day, if we can verify that the asking price and the purchase price have a gap, in this case, 75,000, we could still assign it, which is wholesale, right? We just wholesale the deal for $5,000 or $10,000 and go on to our next deal. Okay? Is everybody with me? Anybody have any questions? We good? Especially my team from Edmonton, this new group from Edmonton. Please, I want you to make sure that you're good. Some of the folks that are on with us right now have seen this before. You need these files. So Mike, send me an email right now saying you need those files, and I'll make a note to send them to you. Okay, Mike? No worries. Okay, I got that. All right. So I want someone to do me a favor real quick. I want to check something. Can someone raise their hand for a second? Someone raise their hand because I want to try something. Oh my gosh. Whoa, hold on. Okay, approve. Okay, can you, those of you who have your hand up, is your mic on? Yes? Okay, give me 1 second. Okay, you know what? Let's do this. Keep your hands down. I'm going to try that after this, okay? But what I wanted to try was, well, here, Fiona, your hand is up. Okay, let me just check something. Oh, I just did that to Ed. Can anybody speak right now? I just want to see if your mics work. Anybody? No sound?
Hi.
All right, no worries. Okay, it's okay. Put your hands down, and we'll look at that. We'll look at that. Okay. Yeah, just put your hands down. Declined. Allow. Okay. Don't worry about it right now. We'll look at it. I might bring in another application that allows you to speak. It's another tool that allows you all to speak with audio that you can use a cell phone or your computer. It's really easy. I was using it today. I also work with the stock program, and we were using it for that. It was very effective. So we can maybe talk about that at the end and see if that's something that we can use. But for now, we're going to continue with this. Okay. So all right. So gross multiplier, everybody knows. The lower the number, the better. 6 is what we're looking for or less. Everybody's good with that? We're good? Any questions before I move on? We good? All right. Okay. All good. All right. Okay, we're going to talk about cap right now. Okay, cap rate, which is really capitalization rate, but cap rate is fine. Okay, so what is cap rate? Maybe your speakers are off? No, Zach, I tried that. It's okay. We'll use another tool. I got another tool for that. Okay, cap rate. So how does cap rate work? Well, cap takes the net operating income. About 2 words. I betcha. Net operating. Okay, net operating income. Net operating income divided by what? Divided by purchase price. Okay, net operating income divided by purchase price. 1 second. a second. I'm just trying to help somebody get online, get into the meeting. There we go. Okay, net operating income divided by purchase price gives us cap rate. Okay, so what does that mean? Who can tell me what that means? What does that really mean? When we say cap rate, we're illustrating what? Cash flow, yeah, okay, yeah, it does help us in cash flow, but again, right, so cap rate is net operating income before purchase price. Now remember something, I want to remind everybody, yeah, return on investment, you got it. Net operating income does not include, carrying costs, right? So that the NOI doesn't include carrying costs, okay? That does not include carrying costs. So why is that important to keep in mind? Well, the net operating income assumes that we paid off the property completely, which is, in this case, $100,000. So, the reason we use the cap rate is the cap rate, it tells us, give me 1 second, it tells us that the property, if I paid off the property completely, that's what would give, that would be the return I would be getting on the property. So in this case, we have a $100,000 property. Well, let's do net operating income first. $13,000 is what we're making, and $13,000 is a combination of what? Expenses and gross income, right? Gross income minus expenses gives us the net operating income, and then I have the purchase price, right? Which in this case is $100,000, right? Okay. So what does that mean? Well, it means equals this divided by this, okay? Which gives us 13, which if we apply it as a percentage, gives us 13%, okay? Does that make sense? So it's basically return on investment if you paid cash. Return on investment if you paid cash, okay? That's what that means. Now remember, if your GRM, right, if your GRM is not in a good place, right, if the GRM is not in a good place, what it will do is it'll make it tougher for you to hit the cap rate, right? The cap rate will be tougher because the GRM is not in place, because they're all a function of each other pretty much. So we want a 10 cap rate or higher. Can anybody tell me why we need a 10 or higher? You can tell me. Why do we need a cap rate of 10 or higher? Okay, that's okay. Okay, I'll let you type. I'm gonna. Yeah, exactly. So creative financing is important to what we do, right? So we need a 10 or higher because at 10 we can afford to do financing at 7%. We could borrow money at 7% for the whole amount, and we'd still be able to make money, right? So if our financing costs us 7%, right? This is just an example. This is not 100%. It would be a combination of more accurate numbers, and obviously if we're paying interest only or principal and interest. But if I had a cap rate of 13 and my financing cost me 7, in theory, I would be still making 5% on the deal, right? It'd still be, and that's going to let me cash flow, right? That's going to let me cash flow. So what we're trying to understand here is we need to have creative financing in our property because we learned, and it'll be learned again and again. Oh yeah, that is 6. Sorry. All right, it's 6. Yes. Okay. So yeah, it would be 6. You got it. Good. So what we want to do is we want to make sure, because at the end of the day, the relationship that we all at this point, I hope everyone understands. If you don't, that's okay. It'll make sense as we run through deals. Is that right? We have 3 categories. We have money, right? We have we have money. We have cash flow, and we have ROI. Okay, so what do we know? So if I have high money, I have high cash flow, but I have low ROI, right? And if I want a high ROI, what do I need to do? Well, I need to put less or low cash, which yes will affect my cash flow low, but it'll give me the highest ROI. Does everybody understand that? This is why we use creative financing, not because it's cool, which it is. The reason is for business principles, right? We want to be able to maximize the opportunity, right? The return on investment, because that's the only way we can really look at, is this a good deal, right? And we can't compare multiple investments if we don't know, the ROI of each, because cash flow can fool you, right? Cash flow can fool you. You can look and say, oh, I'm getting high cash flow, but your return is not very good at all. And if that's the case, that's a problem, because we're looking to stretch out the money as big as possible. And if we can't do that, if we use all our money and put all our eggs in one basket, so to speak. Okay, does that make sense to everybody? So we need that cap rate. Yeah, we need that cap rate to help us, use creative financing. Because if we can't use creative financing, it's not worth it. We can make technically any property cash flow by simply paying it off, but that doesn't mean it's a good investment. Obviously, we want to be able to stretch our money as large as possible to achieve the best and most for our money. Okay. Now, cap rate. Last thing I want to say about cap rate is a metric that we use, a number that we use. Because it represents if I paid the property off completely, this is my return. Cash on cash return, which is cash on cash ROI, is different. Okay, so we'll get to that in a second. Now let's look at, now that we've done GRM and cap rate. Does everybody understand cap rate now? Do we have any questions about cap rate? And if you do, that's okay. Any questions about cap rate? Okay. So let's look at, good. Let's look at value of property. Okay. So what happens to our cap rate when we introduce creative financing? Nothing happens to the cap rate, Kevin. It stays the same. The cap rate won't change no matter what we do in creative financing, because cap rate always makes the assumption that you paid it off, that you completely paid off the property. So it's not going to affect your cap rate. Now, will it affect, our cash flow per unit per month? Yes, it will, right? The creative financing, because the financing is obviously carrying the property and financing it's going to take some of that gross dollars away. The net operating income will be affected by that. So net operating income is what gets affected by the creative financing, or any sort of financing, really. So let's look at the value of property, and what does that mean? Well, why do we have a property that we're buying for purchase price $100,000, and the asking price less important at this point, but purchase price is $100,000? We come down here and we look, it says our value of the property is $100,000. Now the reason that is because for us as investors, we look at the cap rate, always the cap rate, to evaluate a property as a base. And then we can do the creative financing and other things to it. But at the end of the day, the reason that this says 130 is because what it does is it says, okay, if this property, let's go down here, if this property, so value of property, what is this? How do we get that? So we look at net operating income, right? And we multiply the net operating income by what? Anybody? By 10, which is what? Why 10? Yep, excellent. By 10. The reason is 10 is our low cap rate. I don't like that there. Let's go over here. That's our low cap rate. Okay, so low or lowest cap rate for a buy and hold. Okay? So if our lowest cap rate, because cap rate, we want cap rate to be 10 or higher, right? In this case, it's 13. If our cap rate is 10, our low cap rate is 10, for us to evaluate a property, we simply take 10 times net operating income to give us value. So an example would be the net operating income is $13,000, and we want to multiply it by 10 as the cap rate. If we do that, we go equals this times this, and that gives us value of 130. Okay, does that make sense? Does that make sense to everybody? That shouldn't be a no, let's make that a number. Yeah, it's that simple. That's all. The reason we use it is because the cap rate, the low cap rate for us needs to be, at a minimum 10. So evaluations are done based on that. So if the property had a net operating income of $15,000, that would give the value of $150,000. Real simple, right? Right? Because at this point in the market, a 10 cap rate is enough for us to make money. A 10 cap rate for buy and hold. Okay, a 10 cap rate is going to be enough for us to make money. Now, I don't want to get into too deep into why 10 works now, but it really has to do with the amount, the cost of money, whether it's through mortgages or creative financing. That's why 10 works. Okay. In some cities, cap rate can be more or less than 10. Do we consider that a number? So actually, in most cities across Canada, the cap rate is actually this number, 3. So, but 3 is the cap rate. Now, for this would actually be the multiple would not be 3. So the cap rate's 3. The multiple is actually, so if we go here and we change the cap rate to 3, this would be equals this divided by 100. And that tells you this divided by 100, which tells you, it's actually multiplied by 100, sorry. Multiplied by, is it 100? It's 10. Hold on one second. So a cap rate of 3 would be 33.3, so the cap rate, if the cap rate's 3 into 100 equals 33.3. Does everybody see that? So the cap rate of 3, so if we divide 100 by 3, it'll give us 33.333. I just put 33.30. So in most cities, retail, right? Retail would be 33 times net operating income. So that property that we would estimate at 150 in markets like not Calgary so much. Calgary is probably a 5 right now, but in between 3 and 5. But at Vancouver or Toronto, that property would be $499, almost $500,000. Yeah, that same property would be $500,000. So going back to your question, most cities in Canada don't have a 10 cap rate. Some get close. Some for a short period, will have a cap rate of 10. But that doesn't last. Can anybody tell me why a cap rate of 10 in a certain market wouldn't last? What would stop it from staying at 10? What would stop it? So out east right now, the cap rates are, 7, 7, between 7 and some are 10, but they have a vacancy challenge. That's another issue. Supply and demand, yeah. So the market would crash. Well, not necessarily crash. If the cap rates were super high, though, Justin, I will say this, that could cause a problem. That could say that the market something's really wrong with the market. It could be a crash at some point happened that created that. Overinflated. The biggest reason, so the reason that it doesn't last, I don't know if overinflated is the right word, but I know where you're coming from there, Aaron. The reason that never lasts or doesn't last very long is investors come in and buy up the properties. And if investors come in and start buying these properties that are cap rating at 10, what happens? Well, the cap rate starts to get smaller and smaller and smaller. And this is why markets like Toronto and Vancouver can't cash flow. They can't cash flow because people are willing to accept a cap rate of 3. You know, and what does that mean? That means they're making 3% against the value of the property. That's it. In this case, we said that the net operating income was $15,000. We would say it was worth $150,000. The market, retail market in those markets, Vancouver and Toronto, would say no, it's worth $500,000 because they're willing to accept a 3% cap rate. Now, investors, real investors, would never accept a 3% cap rate because it would mean what? What would it mean if I was taking a 3% cap rate? What would it mean? What would happen? The ROI, okay, paying less cash flow. Yeah, let me give you an example. We'd be bleeding money. We'd be bleeding money. So let me give you an example. Let's do this. Okay, so 10,000. All right. Let's go 7,000. So let's assume 70,000. Do it again, just to give you an idea what that affected. So that right there is still a 4.5. Let's go 6,000. It'll make sense in a second. 5,000. That's close enough. Okay. So if the gross revenue is 5,000 on this $100,000 property, okay, it's 5,000, and the expenses are 1,750, the net operating income would be 3,250, which is basically giving us the cap rate. Now look what happens when we go down and look at the rest of the numbers. The GRM is 20. The cap rate is 3.3. The value of the property is 32,000. This property originally was 100 or 275 if we use that number, but let's use that number because it's more realistic to the range, the asking price versus purchase. So we see 20% GRM, cap rates at 3.3, and here's the problem right here. Look at this. Our value of our property is 32,000. Why do we say that? Well, per unit, we're losing $107, and our cash-on-cash return is minus 51. So you can see that when you have a low cap rate, and this is a lot of the state of Canada for novice investors. They invest at this 3% cap rate, and they're losing $100 per unit. And even though they're losing money on their investment, they're telling themselves it's okay because I'm going to own this house in 25 years. This, for us, is considered extremely dangerous. It's a liability, and if things can very quickly turn on you if you're bleeding money, especially if your main income's gone. So in Calgary or Toronto, or at least 3 to 5 cap rate, and they can't cash flow, does that mean the buy and hold are not the way to go at this time? Well, this is what I want to tell you. Let the numbers tell you what to do. Now remember something. The 3 cap rate, or even a 5 cap rate, say 3 to 5 cap rate in Calgary, that's considered retail. Retail, right? We don't buy retail. And why is retail not something we pursue? Well, the bottom line is this. You don't get paid unless you solve a problem. We focus on solutions. And with the retail property, there isn't really a problem, right? If a property is in mint condition in a perfect neighborhood, there's no problem to solve. Therefore, we don't deserve to get paid, at the end of the day. So, if you're looking at properties in Calgary, even Vancouver or Toronto, is there opportunities to work with? Well, yeah, there absolutely is. Are you going to find buy and hold? Less rare. They're going to be rare unless there's some challenges with the seller, the distressed seller. That's more you're going to find in those markets is the opportunity for rent to own. That's what you're going to find. And the reason you're going to get rent to own to work in those markets is because in rent to own markets and opportunities for rent to own, or fix it flips, wholesale, exactly. Edmonton's pretty much the same. It's not as I'd say just for rule of thumb, they're going to be relatively the same. Edmonton, we might see a little bit better. It depends, though. It seems that Calgary and Edmonton, when things are going great, they're both going up. Calgary seems to race a little bit higher at times, and so does Edmonton. But in the reverse, We see Calgary because, whichever market races up faster is the one that hurts more when things turn around. The good news about, it's really not about what are the good markets. When you say that question, Julian, it's what are the good markets for what strategy. So any market is good if you apply the right strategy. Does that make sense to everybody? That's really what it is. Yeah, it's just that's what it is. It's not the market. We got to get away from this idea that we can chase markets and we can predict stuff. That stuff is dangerous and unpredictable, right? So what we want to do is we want to apply the proper strategy for the right market, and that might be Edmonton and Calgary. I believe actually is a great opportunity right now. I think that there's going to be some awesome buy and hold opportunities. I believe the market this year is going to do well. If we continue to see oil increase in value, and it looks like oil is making another charge, this will be important. We have the pipeline also. That's going to be thousands of jobs in Calgary and Alberta and Vancouver too when they sort that out. So I see really big things for Edmonton and Calgary, really big things. I think this is going to be a wonderful year for them. I'm hoping, especially because they've suffered quite a bit in their housing market, and I could totally see Edmonton and Calgary, Alberta leading the way in Canada for one of the hot markets up and coming. Edmonton's been, in the last 4 years, I've been told by those who invest directly in Edmonton, Tim being one of them. Some of you met him. He told me that Edmonton was one of the hottest markets in the last 4 years for opportunities for rent to own and other real estate strategies. So those of you in that Alberta area, things are looking up for you. Looks like. I mean, the market can change, but it's looking up. So hopefully that trend will continue, and we'll see a uptick this year for them. BC, depending on what where they land on this pipeline thing, we might see BC stabilize and even rise a little bit. They took a huge hit last year. 6.5%, I believe, was the last number I saw for the drop. Toronto's gonna see some pain, I think, this year. The last report, there was something like 14% drop last month. It's hard to believe these numbers, how accurate they are because of the way they calculate them. The bigger message, I think, is that the market has started to slow and reverse in the Toronto area, the GT area, and maybe even in the Golden Horseshoe. For those of you in the area, we might see that too. So I think that again, it doesn't matter. What matters is that we understand what's going on and what strategy to use. Don't believe, it doesn't matter where you are in Canada. If you're solving problems, you'll make money. And the market changes reflects new problems in those particular areas. So, when markets fall, there's a different problem that's being reported through the housing market. When the markets stabilize and start rising, that's a different problem, right? When the markets are rising and they're aggressively moving up, that's a different problem too. All of those calling for a different strategy. That's going to be the easiest one to apply for opportunity. Okay. So again, focused on solutions. That's what's going to get us there. Okay. All right. So we understand value of property. Yes, everybody understand value of property. Any questions with that? If you do, that's okay. Let's move this back to 20,000. Okay. And again, I want you to understand something. This sheet is really about looking at an opportunity with very little information and saying, there might be an opportunity here. Let me get the rest of the information. Because this expense at 35 is not always going to be the case, right? It could be 40, 50, 60 even. So, excuse me, we have to make sure that we run the expenses accurately. This is just assuming a 35, but this could be easily a much larger number. And I want to make sure that everybody understands that. That's why we have the other sheet to evaluate a much deeper drill down on the numbers and financing, okay? Same with the James Bond. The James Bond, just a quick calculation. That number is going to change when, up or down slightly, typically down a little bit when we look at financing, okay? So, again, we use this for quick calculation. It's not our final numbers, right? So once we've run property on this calculation, which is here, 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 and here, if the number looks healthy, if these metrics look healthy, which in this case they do, we would want to run a much deeper analysis on the second sheet, the second cash flow sheet, okay? Does that make sense for everybody? So this is really quick. We can do it really fast, and then we'll use the second one to drill down. Okay, let's look at cash flow per unit per month. Real simple, right? We're looking at, this is the cash flow, and then we divide it by the number of units. That's all. This is the cash flow. We divide it by the number of units. We're looking for, 75 per unit would be nice. We really don't want to take less than $75. And again, $75 includes, all expenses. All expenses are paid. Maintenance, property management, vacancy, all covered. That's $95 free and clear. So that's a great return. Okay. Does anybody need me to explain this one? We all good? So per unit, all it simply is cash flow, right, divided by the number of units. That's all. Cash flow divided by the number of units. Okay. Not too complicated at all. Pretty simple to see the relationship. Okay. All right. Let's look at this last one. Cash on cash return. So cash on cash return. What is it doing? Well, cash on cash return. Let's look it over here. So cash on cash return. What does that mean? Return. It means how much did I put in? So investment. And we talked about this. That's not investment, but let's look at that again. Divided by investment divided by, income divided by investment is what it is. Income divided by investment. Okay, so income divided by investment is what it is. So when we look at that, the two of these, we see that the income on this property, right, and this is the income after carrying costs, is how much? It's $4,600, right? We see that, the cash flow, okay, the end cash flow. And we look at income. So the income is $4,600. That's the cash flow, right? So income, and let me just put cash flow, CF, cash flow, okay? And we divide that by our investment. Now, our investment is not purchase price in this case. That would be more like cap rate. So our investment in this one is what? Well, out of pocket is $10,000. So we look at that and we see $10,000 is our investment, right? And then we do what? We go equals this divided by this equals 46, which we look at as a percentage. It's 46%. Okay? So 46 represents the income, the cash flow, the net cash flow. And then we have investment, $10,000. That's what's going to give us the cash flow, the return on investment of the amount of money we put in. Okay? Everybody see that? So if we put, let's, as an example, to see this, how this is affected, if we put less money in, you see that the cash on cash return is much higher, much higher. No audio? Can you hear me? Oh, okay. Oh, I don't know what that is. It's back. Okay. So cash on cash. Can everybody see that? So if I put less money in, that's going to give me a better return, right? Now, this isn't completely accurate as a 92 because if I put only 5,000 in, obviously my carrying cost. So instead of me putting 5,000 in, I would. So let's make that a 5%. I'd have to make it up somewhere else. I'd make it up there, right? And that's going to change, the cost of me, carrying cost of me, and that's going to change this number slightly. But I'm still going to be quite high. I'm still going to be, 85, 90 even, percentage-wise. And can everyone understand that's really, this is really, really important, okay? If we go back to 10,000, this is important. We have a 46% return, which is great, excellent, right? And we like to see, double digits. If I have $100,000, I can do this 10 times, right? if I have $100,000 and I put up, 25,000 per property, I can only do that 4 times, right? And if I do that 4 times, I'm only getting 4 times that. So to give you an example, so cash flow, let's go, cash flow is 4,600, okay? And we say our return is, our cash in, actually, let's do it this way. So this actually goes to this relationship. So if we go over here and we look, we see that if I put in, for money, if I put in 25,000, even though the cash flow will be higher, right? The cash flow will be higher because we're now in this level, right? So high money, high cash flow. So let's say the cash flow would not be 4,600, say it would be 6,500, okay? And we look at and we go equals this divided by this, okay? And we get 26%. Okay, is everybody with me? Okay. And then we go, okay, well, yeah, and I'll go back to the main sheet. You can download it, and we can look at it. Okay. Yeah. If anybody needs it beyond that, yeah, no problem. I'll send it to you. So let's go. Let's lower it. Let's go 15,000. 15,000 would maybe give me a 5,500. It's actually higher, but 5,500. If I do this, now I'm 37%, right? And, if I go back to 10,000, like in this property, I'm at 4,600, right? And that gives me 46%. Does everybody understand what I'm doing here? Does everybody see that relationship? It's really important. That's not percentages. That is money. Okay. So the reason that's so important is because I want you to see that for us to achieve a maximum spread of our capital, right, and our ability really to attract creative financing, even, right, is to get that higher return, because now we can offer, a great return to our investors, right, an awesome return of our investors, because we have a higher net return ROI on our cash, right? So now we can offer and say, well, look, there's 10,000. I've got 10,000 in this property. I'm making 4,600. If I got 46%, what could I offer the investor? Well, I could offer the investor 20%, and I'd still be in great shape, right? So the investor could get 20 here. Could I give the investor 20 here? I could. That's going to give me 17. If I give the investor 20 here, I'm only going to get 6% remaining. Does that make sense to everybody? So if I go 20, 20, and 20 for percentages, should have went decimal. So if I do this as a percentage for my investors, right? Let's go percentage. Percentage. So let's say this is for our investors. Okay, so our investors, this is what we're offering our investors. What does that leave me? Well, equals this minus this, this here, which means that I'm making 6% here, and, here I'm still making a health of 26%, right? Now, this is me replacing my investment, right? So obviously, if I can get these guys replaced, I'm at a zero investment, and if I have a zero investment, what is my return? If I have a zero investment, any cash flow, yeah, it's infinite. It's absolutely infinite. So which is great, right? The thing I want you to recognize is not all infinite returns are created equal, because even though I have an infinite return with this one, I'm only making equals 6%. This times equals this times, let me double check that worked out. $390, is that right? Let me see. Let me double check that. Because I make 6%, 26. Yeah, I make 6% of that 20. That means equals, sorry, I'm just in my head right now, equals this times this. No, that's not right. Okay, it's against the whole amount. I made a mistake there. So it's equals 6%. There it is. Times this, and then this equals this times this, and that'll give us 25,000, right? Or sorry, 6,500. Yeah, 6,500. Okay, so you see, let's actually do this. This is a good example. So does everybody see? So this is our end. So we make, and our investor makes, right? Investor makes. Okay, does everybody see that? So we make, and this, if we shared the wealth, right, which we want to do, and we shared it with our investors, okay? Investor makes, right? We see that the investor's making 5,000, we're making 1,500. Here it's a little bit better, 3,025, but we're still making a less amount. Here at 46%, we're still offering everybody 20%, right? In each one of these deals, we're making 2,600 a year. They're making 2,000 a year. Now, in addition to that, does everybody see the value of that, right? Everybody understands that, why this is important? Everybody got this? Does anybody have any questions? Everybody understands, yes? And if you don't, that's okay. That's okay. I want you to tell me here, and I can explain it. You know, because typically it's not one person. It's several people maybe that don't see the value, or don't see the information the same way, and then maybe don't completely understand it. So if the investor, so remember, what are we trying to do? We're trying to replace this money over here, right? We're trying to replace this money. So we get an investor and we say, we'll offer you 20%. And if we offer them 20%, we make 26 total off this deal. We're going to make 6%. Here, we offer 20% because it's 37, we get 17. And here, we offer 20% and we make 26 because the end number is 46. So we can see that it's important for us to make that nice return so we can balance out and share the wealth properly with our investor. You know, this is, you know, here is probably the, you know, the best, you know, correlation, you know, best split for the investor and us. This is a nice split. Here, the investor is getting more, which we don't mind, really. We don't mind if the investor is making a little bit more. But this one is a no, right? That's not good. You know, that's not really good for us. So we want to make sure that the balance and sustainability, the ability to keep repeating this is there. I don't get how the investor would make that same 20% return, but would make less money if they put in more money, if we put less. Let me read that again. I don't get how the investor would make that same 20% return, but would make less money if they put in more money, is we put less. Okay, so I think I understand what you're saying to me. So I'm just saying, if you have an investor, so let's say your investor is looking for, that's okay. Let's say you have an investor, that doesn't even spell investor. Okay, investor. There we go. Okay, yeah. So if your investor says, I'm looking for a 20% return, that's what they're looking for, okay? You can see how it affects the different types of investment. The only way you're going to raise money, Lori, is you know, say this investor is looking for 20%, you know, whether it's this deal or this deal or this deal, you want to offer them the 20% to get that money. So it's the investor dictating, or you dictating to the investor what you can give. Now, at 20%, how hard would it be for us to attract money? How hard? Would it be hard to attract money at 20%? I mean, no, right? Pretty easy. Yeah, pretty easy for us to do that. So you want to be able to give them healthy returns. Now, you know, can you give them 10? Could you give them 10? Well, sure, we could give them 10. Let's do it that way. We could give them 10% on these opportunities. And would it be better for us? Yeah, you can see the numbers. The numbers look better for us, right? We have 3,600 this case. They make 1,000. We have 4,000. They make 1,500. We have 4,000. They make 2,500, right? And the important thing to keep in mind when you're offering the 10, when you're offering the 10 is the lower you go, right? The lower you go, you're going to attract less investors, right? So increased seller financing makes us able to reduce our input. Yeah, So increased seller financing. Exactly what it does, Rod. Exactly what it does. 100%. 100%. As you get lower and lower as the investor, like producing for the investor, you know, you're gonna attract less and less people. It is 10% interest rate from the seller. Well, no, this isn't the case of the investor. It could be from the seller or someone else giving us the money. We don't know. I mean, it could come from anywhere, if any. It doesn't matter, right? The main thing is to understand that when your return is small, you have to be realistic. What can I offer? What can I really offer? What's realistic? Could I offer 5%? How many investors would I attract at 5%? I mean, 10's going to get you in the game for sure. 10's still great, but you know what? What if you offered 25? Well, look, at 25, which is an awesome return, obviously, it's ridiculously awesome. Look, if you tried to do a 25 on this, you'd make $250 a year. It'd be worthless. If you try to do, on this one, a little bit better, but still, it would be rough. This one's the only one that you got a shot at. It's almost even. We're making less, but we could still offer a 25% return on this and still make money on it. Does everybody see that? Yeah. So I want you to share the wealth for sure, but it has to be sustainable. We're not going to. We could do 15. Let's look at 15. 15 would be good for us. The investor's still making a decent return. I think that a split would be around 21% for this one. That's a little bit higher. 23%. Yeah, there you go. 23% would give you a split on the bottom one. Okay. My question was more in the sense that if we put in less money, so let's say 5K or less, that means the money needs to come from investor or creative financing. So if the investor is putting in more money, why is the return at 20%? Why is the return at 20%? The percentage itself, the return that you're giving them, the investor, is totally up to us. We determine that. We decide that. The question becomes, it is the interest rate. It wasn't complete. Okay. I'm going to try to explain, and you keep writing, Lori, if you're not clear. So the investor, the amount we give to the investor is up to us. What I'm trying to say is that, it's up to us to create this here, this investment from our money. This is our money. We put up this money. Okay? It's up to us to create a decent return to be able to share the wealth with an investor to get all of our money out. Does everybody understand that? Does that make sense, Lori? Yeah, I'm just giving you an example. And you remember where we started with this? We were talking about cash on cash return. So once we have a property and we put in this case, it was originally 10,000. Like in this example, if we put 10,000 in and we make 4,600, that's a 46% return. Now the next question becomes for us, how do I get this 10,000 out? Because we want to get the 10,000 out so we can use it again. I get that part. It's when I look at what the investor makes versus what we make. Okay, so let's look at 10%. Okay, so right now, let's pretend we're here. Okay, we've made. Let's look at this one in particular. Okay, so here, 10,000 in, 4,600. We've made 46%. Okay, so now we're saying to ourselves, how do I get that 10,000 out? Well, what if I offer the investor a 10% return? What would that do? Well, if I offer the investor a 10% return, they'll make how much? 10% return, they're going to make $1,000, right? Because they're putting up the 10,000. I'm giving them 10%. They make 1,000, which leaves how much of the cash flow for me? It leaves $3,600. Okay, you with me, Lori? Does that make sense? Okay, good. All right. So the question, Lori, we have to ask ourselves is, and we got to recognize the higher return I'm willing to give, the bigger pool of people that are going to want to invest with me. And if I have a nice return like this 46, I can go pretty high. I could go to 23, was it? 23% as a return. I can offer that return to the investor because this deal is good. I can offer 23% and still, be a split on that income, which allows me to free up this $10,000, right? So now I can free up this $10,000. And what does that do for me? I can take that $10,000 and I can invest all over again. Does that answer your question about the investor? Right? Really, it's up to us what the investor is going to get. Just up to us. But the higher we can offer as a return, the more people are going to want to invest with us. Does that make sense? Good, Donald. Lori, is that good for you? If not, Lori, good. Yeah, and Lori, if you have more questions for that, you can reach out to me. Okay, I have no problem spending some more time with you. Okay, not a problem whatsoever. It's important for me that you understand this. Okay. All right. So when we look at this, going back to this, the cash on cash return, 92% because I dropped this to 5. But if we go back to 10 and drop this to 15, so we can get the 100%, 100,000. If we put 10,000 in this property, the cash on cash return is 46%. Okay, cash per unit. Now we understand. We understand all these metrics and what they mean. Does anybody have any questions about it? Lori, you're saying that'd be great if, yeah, Lori, send me an email, put any questions that you have in there, and we'll spend more time, me and you, on it, okay? No problem. Okay, does everybody, especially my group from Edmonton, but I know some of you haven't seen this either, does everybody understand how this sheet works? Does everybody understand? Good. Is there anybody that needs additional review of it? It's okay if you do. Is everybody clear on it? Okay, good. Good. Okay, so what I'm going to do now is I'm going to take off the share because I want to allow you to download those indicators, that 6 key indicators, now that you understand what it means. Let me do this. Okay, so there's the 6 key indicators and there's other files here that I want everybody to get. So I'm going to give you a moment again. Can anybody who doesn't have these files, because someone mentioned that they didn't, can you please grab these files now? Open them up, make sure they work. There's going to be challenges if you're on a tablet. There's going to be challenges if you're on a cell phone. It needs to be on a laptop, and you need to be able to run Windows Office, because these are an Office format. Okay? Okay, good, Rod. Yeah. All right. Okay, so actually, I want to look at another file. Okay, let me. Yeah, Kev, I haven't sent it out. I'll do it at the end of the session, sometime tonight. Okay. Yeah, no worries, no worries. Okay, so any questions? Any questions at this point? Want to do a couple more things? We have about 15 minutes left. We good? Okay. So, you know what? I'm going to do the share again because I want to look at something. So let's go. Okay, so we're going to do share my screen. 1 second. All right, let's look at my screen again. Okay, share my screen. Okay. All right. All right. Okay. All right. Okay. So what I want to show you is this document here, and this is a great document. This is related to um, uh, a lease to own, rent to own document that you will get from Tim and Ray or Ray when you take that class, or log onto that when you're ready to take that class. You'll get all these documents, but this particular document I want to mention to financing options regarding the cottage property we spoke about today. Okay, so is anybody interested? If anybody's interested, well, let's do this at the end. So Karen, remind me at the end. I'll tell you when we're going to do that. I just don't want to do it now because I want to pause it if somebody pops up an email. Okay, but remind me at the end when I say we're wrapping up, and we'll talk about that then, and that way I can stop the recording. Yeah, no worries. Okay. The thing that Karen, Rob, they're talking about a property. Please don't respond to the property, but I'll ask at the end if anybody's interested to pop up their email, and Karen, Rob can look at that. You can get together with them and see if there's a property, if there's an opportunity for you to do a deal with them, okay? A joint venture or lending or whatever it is, okay? So we're going to do that at the end, so please don't pop up your emails because this is recorded and I don't want anybody to see your emails unless absolutely necessary, which is very rare. I would say never. Okay, I got your email, Karen. I'll respond tomorrow. Good. Well, that's good. Good. Okay, so let's look at this document for a second. Okay, this document is basically saying, and I got this from Sierra, actually. We were talking yesterday about a client that was kind of odd, asking some weird stuff, and was asking for her business partners' information. Who's your network, who's your business partners, who are they? And I wanna make something clear, okay? So we're not in the business of trying to prove who we are. We're in the business of putting up opportunities for people to get involved with, and them making sure that it's good for them and us making sure it's good for us. That's how we do it, win-win. Now, the way to do that and approach a situation where someone's maybe doubting you or not, not sure who you are, the best thing I think that you can tell them is to say, look, we provide property solutions. It's important to us that all our clients and people we do deals with get what they're looking for, because we definitely won't get involved in a deal that's not going to allow us to get what we're looking for. So what we require and insist by all our clients is to seek their own legal advice. Does everybody see that? Right? That's not a good color, but let's try that color. Everybody see that? This document here is saying, look, you've been told that you should seek your own independent legal advice and counsel as to your rights, obligation, remedies, if any, that may be subject to regarding the aforementioned document, and that I have been given the opportunity to seek legal advice. Does everybody see that? That's important. Now you can actually, and I would want you to do this, okay? You see this piece here? This piece here can be made into its own document, just like that. So I'll give you an example. So let's do new. Okay, so this here is a document that I would want you to do on every deal. Just make it nice and big, and we have at the bottom the signature. So let's go back to the other one. So here we go, certification of independent legal advice acknowledgement. Put that there. Then I would just simply have on the bottom this here. And it doesn't even have to have the witness part, but that's okay. You can do it like that. Put it down here. And we could get rid of the, just put signature and date. Signature and date. Witness, you can do. That's never bad. I mean, it's not bad to get a witness and date. But the big thing is to have them sign it and you sign it, okay? And that you have a copy of this. That's the big thing. you know? So, like this. Okay, does everybody see this? Let's get rid of that. Okay, so now we have a document that basically says, let me go back. That document says what? Certificate, of independent legal advice, confirmation, and acknowledgement. What's it say? We have been advised, and the person puts their name in there, we should seek independent legal advice and counsel as to my rights, obligation, remedies, if any, that I may have to be subject to regarding the aforementioned documents, then I have been given the opportunity to seek legal advice. This document is the document you pull out, just like this. When they talk about, well, what about, who you are? I don't know who you are. Say, look, I want you to understand something. We use lawyers. We have a power team that makes sure that we're protected, and we insist that, and strongly suggest to you that you should seek your own legal advice. In fact, what we do is we have this document here, Mr. Smith or Mrs. Smith, and we'd like you to sign off that we have done that because it's important to us that you're protected. See, we need to recognize something. Middle class and working class people, unfortunately, are used to people giving up their freedom and their rights when it comes to a lot of things, but in this case, finance. They want other people to protect them. They want other people to be responsible for their failures because they've been conditioned for that, and that's a tragedy, right? People want other people to take care of who they, the result of their life, and for us and all of you, that's something that we're moving away from. We want to be, in charge of our own life and our own finances. Who do we give that to? Anybody we are doing business with. Can you separate it with the aforementioned document in the text? What do you mean by that, Rod? The aforementioned document here, this part? Well, you're only giving it to them, Rod. You're only giving it to them when you're giving them documents, right? Yeah. Do you see what I mean, Rod? You're only giving them this. You're only giving this document when we have a document. If we don't have a document, there's really, what they don't really need to see a lawyer or get legal advice. So when we do any sort of document at all, any sort of document with individuals, we want to tell them that we want them to go see a lawyer. We want them to protect themselves. It's important to us that there's a win-win, and we want to make sure they're taken care of. In fact, this document, I just would like you to read over and sign for me that it's clear that I've asked you to go get legal advice. Now, at this point, if they don't get legal advice, you can't be held accountable, right? You can't be held accountable. You can lead a horse to water, but you can't make him drink. So that's the case when someone just refuses to get that kind of help. Okay? Thanks, Vince. Joey. If we had a lawyer, why would we have to provide this form? If we had a lawyer, Fenny, this is for them, not us. So, Fenny, they're signing this. We're telling them to get a lawyer. We have lawyers. We're telling them to get a lawyer. Does that make sense? So, Fenny, this is for them. Yeah, exactly, Fenny. We're making sure they go see a lawyer. That's what we're, that's the big deal. Is we want to make sure that they go see a lawyer. That's important to us, And you could have, why don't we do this? Let me do this, and have a third one, just to make sure if there's a couple. Oh. There you go. So, and you know what? We might have a partner, so let's do this. So what I'm going to do is I'm going to make this document available to you. Okay? Give me 1 second. Okay. So there's 4 signatures there if there's partnerships. And you can identify who you are. You can say who you are. We can put... we can add here, let's do this. What's that title? Okay, let's do this. Sorry guys, I'm just kind of creating this as we go because I want to be able to give it to you now. So let's do this. Okay, there we go. All right. Show them we have nothing to hide. Yeah, absolutely. It's to protect us as well as the way they cannot say that we were not honest and clear with them. Yeah, exactly. Do you need printed name also or a signature enough? Printed, your printed name or their printed name, you mean? Oh, yeah, you could do that too. Why not? That's a good idea. So there we go. We got another line. I think we had that in the other document. Yeah, you should have printed for sure. You should have printed so it's legible so you can see it. Good point. So let's go here. Signature, and let's do this. Let's do another line because that's going to be a problem for space. I'll tell you what. Let me. So I wanted to give this to you now. That's why I wanted to do this now. Let's do this. Let's go. I got an idea. At the bottom of the page. Well, let's do this because there's 4, right? So let's do that. Let's do that, and let's go. Print. Print. Name, and let's go title, like that. All right, here we go. And now what we're going to do is do that. And then we're going to go like this. And we're going to go down here and do that. And then we'll go up here. There we go. Okay, so we have date, title. What we can do is, I really don't want to make that any really smaller, but we'll do that. Just make space. Okay, any other suggestions? Are we good? Try name and title on one line. You guys are killing me right now. Oh gosh. All right, let's do this. You can modify the document. I would love it if you took it to your lawyer, right, to review, which it's not a huge document. You can just look at it. One date for all signatures. Yeah, you can do that. So what we can do, would you like a copy of this, folks? So let's do this. Let's go. Give me 1 second. Here, let me stop sharing for a second. Okay, let me upload those files. Okay, give me a second. Okay, let's do this one for the. Okay, so we're gonna call these 1 and 2. So file, save as. Let's go. 1. Okay. So we're going to do 1 for lease options. Okay. Because that document is there. And then I'm going to do another one for, give me 1 second. We're going to do 2 is going to be just a standard one. Okay. So let's do this. Okay. Let's get rid of this. Hide. Let's go over here. Okay, so anybody who needs the files, those files will be up there, but now I'm going to add the 2 disclosures. Here we go. 1 second. Is it? Okay, there we go. So it's just going to take a minute. Now you can see it. And I'll give you the second one. There we go. Okay, everybody got those? I'll pay to get them done soon. I can certainly share with you guys. I have Translator talking about her interpreter class with me. Oh, cool. Good, Mike. Please send me the email wherever you get it. Send. Thanks, Mikey. Okay. Oh, no worries. So everybody grab those files. Okay, good. Just open them up, make sure they open. And you know, again, I'm telling all of you, seek legal advice. You know, let your lawyer look at the document, review it, you know, and protect yourself. Take accountability for your own actions. You know I'm here to support you, and I want all the success in the world for you guys, and I want to, you know, I want you guys to get where you want to go, and to do that, you know, I want you to be independent in that you recognize that you're accountable for your actions. So I definitely will be there to support you. The mentors will be there, the coaches will be there, the trainers will be there, Legacy will be there. Just, you know, I want you to feel confident and strong when you're doing this stuff, and I want you to be fair and honest, obviously, with people that you deal with, and I don't want you to be afraid to say these things to them. Say, you know, look, I you know that I will be protecting myself because I have legal advice. We always want win-win transactions, so please, we're insisting that you know, at least recognize that, you know, you should get legal counsel. Here's a document that actually says that I told you to go get legal document. That's how important it is to us, okay? Any questions? No, everybody's good? I can't find the files for downloading. What do you mean, Gary? Good. Gary, can you see the files, Gary? You can't see the files at all? What are you doing it off a phone, Gary? iPad. Yeah, tablet. Yeah, your tablet is not going to let you download them unless you have access to it. So Gary, do you want me to send you these files? Okay, Gary, email me right now. Email me right now and request those files. Say, Sam, can you send me the files from the webinar tonight? Yes. So Lori, same thing. You got to email me right now, and I'll email all of you back sometime tonight. By tomorrow, you'll all have it. Those of you who want it. So I have Gary, Lori. Oh, Gary. I got Kevin. I got Mike. I got Kevin and Heidi. I got Cody. I got Aaron. Okay? All those people I'm emailing these documents to. Does anybody else need them? Because if you already have them, if you can download them from here, that would be better, obviously. But you need to let me know so I make a note, because I'm making a note for all those individuals because I want to make sure you get that. Sure, Anna. Do you want it, Anna? You lost all past files. I'd like them too, please. Dave. So Dave, can you not download them, Dave? Because I can send them to you, no worries. If you can't download them, I'll send them. You just got to send me an email. So Dave, just send me an email. Say, Sam, can you send me the files? No problem. But you got to send me an email. I'd like them too, please. Okay, so Dave, I got you. And okay. If we were in Quebec, is it better to choose someone who invests in Quebec as a mentor, right? And preferably speaks French. Yeah, Anna, we got. Yeah, I would do that. Yeah, I would do that. If that's the area you're going to invest in, yeah, I would do that. You know, I mean, Anna, you know, it really doesn't matter, but you might feel more comfortable with that individual. But really, it really doesn't matter. All you got to do is make sure, and they do. The mentor, whoever you're getting, understands the rules and regulations of that province, and the mentors do. So, and the great thing about the team that we have is what they don't know, they can always get access to through our network. So, and if you're interested in mentor, anybody who's looking at their mentorship right now, you can reach out to our office. If you want, though, you can send an email to me and I'll send it to the office. It's okay. I have no problem doing that. Are these the files from last week, including in this file list? Yep, it is. The only new ones are certification of independent, the legal documents 1 and 2. That's all. Yeah, that's all. So I was going to get my lawyer on. He actually texted me to get on, but I wanted to make sure that we covered what we wanted to cover this week. I'm scheduling my mortgage broker and financial advisor is confirmed for next week. He will be there on the call next week. So what I want to do is, and tonight there was a couple deals that I wanted to go through, but we're really running sharp on time here. So what I want to do, Cody, usually that starts after you've taken a couple classes, depending on your program. To answer your question about when does mentorship start. So there's a few people that I wanted to talk to about, stuff they're looking at. So what I'm going to do is set up some times tomorrow to talk to them about that. So I know that Donald, you had some deals that we were going to talk about, correct? You found a 10K house, yeah. So Donald, I want you to text me tomorrow when you have time, or tonight, whatever you want, we'll set that up, and we'll have a conversation one-on-one. Okay? I want to make sure that you're taken care of. There was also, just looking at my notes. Give me 1 second. If you send me an email to talk about a property, please, tell me who you are. I have a couple people already I was looking with. Stephen, you also, right? Stephen's on the call, right? Stephen, not on the call right now. So Stephen, I'll take care of. Okay. Also, my group from Edmonton, my new group from Edmonton, a couple of you, we talked today. Yep. Working on it right now. It needs to be moved. I need to find a lot closer to the property. Oh, that's Mike. Okay. My group from Edmonton, I talked to a couple of you today, and we can continue that conversation tomorrow, and continue on those properties we're looking at. So let me see. Where are you? Here we go. So Kev, you there, Kev? So Kev, we'll talk again tomorrow. I know you're on the job site tomorrow. So in the morning, if you want to call, reach out, Kev. We can do that. Okay? But Kev, run the numbers tonight with what you have and see what it looks like, and get the estimated rent, and let's see what the numbers look like, and then we can evaluate where we're going to go from next, okay? Good. And anybody else that needs help on something that they're working on right now? That's time sensitive. Okay, Fiona, right? We talked today. So if you want, we can have another touch base tomorrow. Yep, that's no problem. You can email me. 10 might be a challenge. But you know what? Text me if I'm available. We'll find some time during the day. Don't worry. About the property I'm trying to rent later this week. Yep, Kev. So this is the deal. Tomorrow's a good day for me. But Thursday is going to be tough. And I'll probably, unless in an emergency situation, I won't be available till next Tuesday. So I'll respond to emails and stuff. And you know the way I work is 24 to 48 hours, except weekends and holidays, because that's my family time. If you need to reach me and something's time sensitive, you can always text me. I'm good with that. Yeah, no worries. So yeah, you all have my contact. You can reach out if you need help. You know, and we'll set that. Yeah, Donald, we'll set something up tomorrow. Good. All right. Anybody else have any questions before we wrap up? Oh, my pleasure. My pleasure. I just want to remind everybody, just again, okay, stay with me, okay? These are the people that I'm emailing. If your name is not listed, please say that you want this information. These are the files. So I have Gary, Lori, Kevin, Mike, Cody, Aaron, Fiona, Kevin and Heidi, and Dave. Anybody else? Everybody else can download these files, right? Has downloaded these files? Everybody's good? Good. Oh, Mike, wait a minute. Mike, I got today's files. Mike, you're good then, right? You don't need it? Mike, you don't need it? Because that's the files. So Mike's good. Okay, so just give me 1 second. So Mike, you got the files, good. Okay. So are you saying to me, yes, you need the files, or no, you're good? So, okay, so Mike, these are the only files. Really, these are the only files, the base files. That I can't think of any files that I'm trying to, like, in my head. If you can think of any files, Mike, that in the past that you think that we had, I can't remember off the top of my head. Because right now I'm looking at sending just these files. If possible, the basic cash flow sheet that you have been running with the past couple of Tuesdays too, please. So Dave, yeah, I'm going to send you the 6 key indicators. Okay? So yes, cash flow sheet. Okay, so Mike, I'll send you everything I got. Who else? These files, only these files. When can we discuss regarding the email we sent you? And so Ed, you're gonna text me tomorrow. Okay, and we're gonna talk 1-on-1, okay, Ed? We'll find some time tomorrow, okay? Yeah, Rod, you can, of course you can. Of course you can, Rod. No worries, my friend. Absolutely. Okay. Any other questions? I will text you also tomorrow. Need to put a deposit on the house ASAP. Okay. So, you know what? This is what I'm going to do, actually. There's a couple of you looking for possible funding for your deals or money. Well, I'm going to bring my broker on next week, so we can talk about that then. But is anybody, please don't put your email yet. Sierra, he was supposed to come on today. He tried to get on. I wouldn't let him on because we didn't have time. Poor guy. I'll try to get him. He did. He texted me. He's like, give me the code. I wouldn't give it to him because there was no time. But I'll try to get him on next week. He's really excited to work with you. He's had work with a couple of you, so he really wants to get involved, more involved. He's just, yeah, exactly. He's a great guy too. He's a great guy. Okay, so this is what I'm going to do. Okay, so everybody listen closely. Okay, there's a couple people that are looking for funding or partnerships on deals. Okay, the individuals. Nobody put their email. Please don't put your email. Okay. Anybody that has a particular deal that they're looking for funding or possible partnership, please say, I'm looking for funding / partnership now. Do that now. Well, we're going to come back to that, Rod, in 1 second. First, let's just see who's looking for who's looking to partner up or looking for money. Let's start there. Who's looking for money right now? I'm looking for funding partnership. Okay, so Karen and Rob. Okay. Who else? Partner up. Okay. Oh, you want to partner up, right? Interested to provide funding. Okay, gentlemen. Yep, both you guys partner up and interested in provide funding. I know you are. Anyone interested in a venture partnership? Anyone? Okay, so here. This is what I'm gonna do. Just slow down. Don't type anything anymore. Okay, I'm letting everybody know that I'm stopping the recording, so you guys can post emails. Don't do that yet. Is there any other questions? Because this session's gonna end right now for recording. Is there any other questions? Are we good? Okay, I'm gonna stop the recording.